than a defined contribution plan. Recognition and measurement. We sort of talked about this a little bit. For a defined contribution plan, you measure it or you recognize it as the service is rendered. It's exactly the same language as dealing with short-term employee benefits. So as you work a week and they put $9 into your superannuation fund, you just debit expense, credit cash. And that's a pretty straightforward thing. For defined benefit plans, the expense recognized for a defined benefit plan is not necessarily that amount because they show the $9 going in, but potentially there might be an expense if there's an issue with the plan assets or the fair value of the plan assets and the present value of the defined benefit obligation. If there's a problem with this, then you may well show additional expense. Now, how you show it, that's actually a really tricky thing, and that's the change that's just happened. So what I'm just going to do is I'm going to pull up Qantas's, some of the information from Qantas, because they got named in that article as well. And it's I think somewhat illuminating just to have a look at. Now, there are a couple of numbers. There's a lot here. I just want to focus on a couple of things. So this is getting down into superannuation. The thing we just want to have a look at is, so changes in the present value of the defined benefit obligation. So this is a change in the liability of Qantas's superannuation. And the only thing I want to look at is actuarial gains and losses. In this case, $183 million. Changes in the fair value of plan assets. So this is the asset side of the equation. In that case, actuarial losses, $178 million. When you add those two numbers together, so this is, you don't have to worry about all the detail there, but just keep in your mind that the total actuarial losses for 2011-12 year for Qantas was $361 million. Now, the question then is, how do you account for that difference? Now, the old standard, and this is the change which that article was referring to. The old standard had three essential ways you could do that. The first way was you could take that difference and you could record it all in OCI. So it would have an effect on the balance sheet because if you're going to put it through OCI, it's got to come up on the balance sheet as well. You put it through OCI, it's not going to change your underlying profit and loss, like your statutory profit and loss, but it is going to have an effect on your equity and it's going to have an effect on your liability side. So that's a choice they had. The second choice, you could put it all through profit and loss, which is obviously going to affect your profit and it's going to affect your liability as well. Given those two choices, what do you reckon most companies, and there's a third choice, but given those two choices, what do you reckon most companies would choose to do? You could take a big profit hit or you could just put it through OCI. Yeah, OCI. They're not going to take the profit hit if they can get away with it. The third method was even better for companies. The third method basically said, in a nutshell, we won't go into the absolute nuts and bolts. The third method is called the corridor method, and this is the thing which has been abolished. That basically said, yes, you can have an actuarial gain or loss, but unless that actuarial gain or loss exceeds a certain amount, and we don't have to worry about what that amount is, but unless that actuarial gain and loss exceeds a certain amount, you don't have to do anything. You don't have to recognize it, you don't have to disclose it, it doesn't appear on the, well, you do have to disclose it, but you don't have to recognize it. It doesn't touch the liabilities, it doesn't touch profit and loss, it doesn't touch OCI. Which method do you reckon most companies probably choose? Someone from the back, you've been a bit quiet up there. 1, 2, 3, 4, 5, 6, 7, 8. There's a 1 and 9, I'm going to pick on someone. What do you reckon? I can wait. Do you reckon they put a loss through OCI, profit and loss, or they just wouldn't disclose, they wouldn't recognize it? I'm tired and you're making me walk up the back. Rightio. What do you reckon? So we already know they prefer to put it through OCI rather than profit loss. So do you reckon they'd prefer to put it through OCI or just nothing at all? Should I do eeny, meeny, miny, mo? It's not a trick question. You guys just look a bit quiet up the back. I'm kind of just, you know, it's 7 o'clock on a Friday evening. Oh, that's just passing the buck. No. Well, I'll ask you, you know, you can ask him back if you want.
The first one, because it doesn't affect profit and loss, because if it would actually affect profit and loss, their profit would decrease, and that's not
Yeah, so you don't want it through profit and loss. So OCI or nothing.
Well, they would prefer nothing.
There you go, that's all you had to say. You prefer nothing. Of course they prefer nothing. If you don't get it, if you don't have to show a liability, you're not going to show a liability. Yes, they'd also prefer not to put it through profit and loss. And that's exactly what a lot of companies did. So just remember that number that we had before. And thank you. Thank you for stepping up where he wouldn't. I'd make him buy you a drink for that afterwards. So Qantas, 300, was it 341 or 361? I think it might have been 361. I added it up wrong. Anyway, 361. What did I say? Yeah, no, I got it right. So $361 million. How much of that $361 million do you reckon they put through profit and loss? None. Close, not quite. They actually did stump up something. How much do you reckon of that do you reckon they put through OCI? None. How much do you reckon they didn't do anything with? All the rest of it, absolutely. Actuarial losses, expense recognized in consolidated net income. Actuarial losses, 20. So of that $361 million actuarial loss, they recognized 20. Their net profit for the year after tax was $244 million loss. There's $341 million of unrecognized losses they haven't put through profit and loss. That would over double their loss. I mean, it's kind of not surprising they did that. And you can actually see this come up. Oop, there we go. And I know you can't really see it. Less unrecognized actuarial losses. Oop. Unrecognized actuarial losses. This increased from 431 million to 772 million. There's $750 million of losses which are not anywhere on the financial statements. Yes, they're in the notes and I can read that number right there. How many people do you reckon bother going and having a look for that number? Probably not that many. The interesting thing, actually talking about looking at notes, you know the whole Enron thing that happened, I mean, it's going back a while ago. You could actually figure that out if you read their notes properly. And that's how it ultimately came undone. Somebody actually started reading their financial reports properly and started figuring out something was going on. The information often is there. But the thing is, most people don't bother looking at all this stuff. And probably for good reason, because a lot of it is pretty boring. But the information is often there to find. So anyway, that's a pretty big number. And that's the number that they're talking about, which is going to come back on. And that change in number is the number that they're talking about, which is going to come back on. So we're not talking small bickies. And just to finish up, and then we'll take a break. The other thing which is kind of interesting, and you can actually find out a lot of stuff from this. I said, I like reading accounting reports. Historical amounts, fair value of plan assets. So these are the assets in relation to their defined benefit plan obligations. So this is the asset side of things. The second line is the obligation. So this is what they're on the hook for to pay out to their employees. We go to 2008. They had $2.1 billion of assets in that plan and $1.8 billion worth of liabilities. So things are looking good. They had a surplus of $296 million. You go to 2012, the assets have actually dropped. The assets, I mean, they dropped quite substantially, but they're actually lower than they were 5 years ago. And it's actually about a 2% drop over time. In terms of the liability, in terms of the obligation, has gone from 1.8 billion to 2.5 billion over that same time period. So now there's a deficit of nearly $500 million. Now, that's an increase over time. It's not a per annum, but it's just a total increase of about 39%. So defined benefit obligations are increasing at a rate, the assets are either staying static or dropping a bit. And that's a problem, that's unfunded. That's the unfunded problem they often talk about. Which then got me thinking, really quickly, about this place's defined benefit plan and what their plan assets and plan and defined benefit obligation was. The fair value of plan assets for here is $125 million. The present value of defined benefit obligations is 582. There is a gap of $457 million, and they've only got $125 million in assets. Like, I don't know whether I'm actually going to get paid ever. Maybe I should be kind of worried about it. So anyway, that was my 2 cents. It is an issue. It's a sizable issue which is going on, so just be aware of that. Anyway, so we'll take a break now because I've been talking for far too long. 7:15, we'll take a break to 7:20. The last little bit won't take too long, but it is important to go through some of the numbers, so we'll take a break. Stretch your legs, grab some caffeine. If you've got any questions, please come up and chat to me. Otherwise, I'll see you back here in 5 minutes.